What is poppin'? It is the Slapton. I am but a lowly Slapton riding these DeFi waves, and this is Today in Crypto, where I give you all the crypto news that is fit to go ape wild over. Now, keep in mind, I am but a lowly Slapton, which means I cannot give you financial advice, but I can provide entertainment and education, and that is exactly what I aim to do. So let's get cracking. So, in my humble opinion, this will be the year. 2022 will be the year of regulation. It will be known for regulation primarily. This will be the year we look back on and say, this is when regulation really came to the crypto and DeFi space. And I think 2022 will be known not just for Terra and for the recession, etc., but for that. When the space matured in the eyes of regulators and companies and institutional entities got into the space comfortably knowing that there were at least guardrails. So the first story is, of course, about regulation. BaFin in Germany. So that is the Germany's Federal Financial Supervisory Authority. It's called BaFin. It's overseen by a woman named Birgit Rodolph. I can't say her name. There it is anyway. There she is, rather. And so Germany has a relatively robust regulatory framework relative to other countries. So one of the things that they can do is they can issue crypto custody licenses. Basically, if you are let's say, a decentralized exchange that wants to hold crypto on behalf of your customers, you can register with BaFin to hold crypto for your customers, and you would be in compliance. You wouldn't have to worry about getting sued or falling out of compliance and having legal issues down the road. So what BaFin is suggesting is that these regulations that exist in Germany be extended to all of the EU, all of the European Union, which is many different countries. And in my humble opinion, as long as these regulations remain I would say reasonable and aren't stifling innovation or putting undue restrictions on companies from doing business, this is exactly what the space needs. The last thing you want is for a company to have to comply in 25 different countries, all with different code and going through 25 different processes. What you want is one uniform regulatory body that has common sense regulation that will streamline the process and give confidence to investors and businesses to enter this space. I mean, the analogy that's always drawn here is to the internet, and the internet really took off when regulators put guardrails, which were not too restrictive but gave confidence that the space was protected and that you could do business without fear of future regulation coming and wrecking everything. So the year of regulation continues, and hey, why not talk about more regulation? So Binance is in talks for regulatory approval in Germany. So just what I had mentioned. Germany has a robust regulatory framework relative to other EU countries and other countries in the world, and Binance wants to get regulated to do business there, and they want to be a licensed cryptocurrency custody solution, right? So now imagine if the last story was true and these regulations expanded to all of the EU. So the minute Binance became approved in Germany, it would also be approved in all of the countries of the EU. Think about the scaling, the streamlined nature of that and the advantages it could bring. So don't be afraid of regulation. Regulation isn't bad. Bad regulation is bad. The devil is in the details. Is that how they say it? Yeah, the devil is in the detail. So speaking of regulation, Celsius, by the way, if you guys aren't familiar, is a yield farm. It's a platform in which you can put your crypto assets and you can get a yield in return. I use Celsius. I will leave an affiliate link. Now, keep in mind that Celsius recently, within the last month, took the initiative to comply with TradFi regulations. So now, if you want to put new assets into this yield platform, you're going to need to be an accredited investor, which means in the United States that you make about $250,000 a year and you have a net worth of $1 million that you can verify, right? So Celsius is another one of these companies. It's been around forever in terms of crypto. It's weathered many bear markets. It has been complying with regulation, and now it's hoping to comply even further with regulation and even in the TradFi space. So one of the things that Celsius offers or one of the subsidiaries that it has is a mining arm of its operation that mines Bitcoin and crypto. And it is looking to file to get an IPO for that mining subsidiary, meaning that it can offer stock to the public if it passes the SEC the filing. So again, another cryptocurrency kind of looking to play with the regulators and the TradFi space. 2022, I'm going to say it again, the year of regulation. But it might also be the year of Coinbase, it seems. At least today is the day of Coinbase, because like every other story I was looking at across all the platforms are about Coinbase. If you guys aren't aware, Coinbase, I mean, who doesn't know Coinbase, but it is the most downloaded wallet over the past year, according to the chief product officer of Coinbase. And what it's looking to do is focus on self-custody, right? So currently right now, if you have a Coinbase account, you are storing your assets on their platform, and they actually have custody. You do not control the keys. Now, again, the reason why I think this is happening is because of regulation. I think if they are the ones holding your assets and they aren't cleared to be a custody solution, then that is a problem, right? And it also opens them up to litigation, because if they lose your coins or if they get hacked, et cetera, et cetera, et cetera, that's on them. Whereas if you hold your wallet and you get hacked, that's on you. That's what they would prefer. And honestly, I think a lot of people would prefer that. I know I would. I know that one of the reasons I like crypto is because I get to control my assets. I don't have to custody them with somebody else. I am somebody who has my own wallet. But, one of the issues with self-custodying is just the technological barriers that people aren't familiar with, one of which is like sending coins to this string, this alphanumeric string that we call, addresses, wallet addresses. So that on Polygon, it starts with OX. So one way to simplify this is with an Ethereum name service, which essentially would take this long string and turn it into something much more human readable, like slapped and swerve at .ens, right? So what Coinbase Wallet is going to do is they're going to allow a user to claim an Ethereum name service for free. That is right, for free. And also they're going to be a provider of know your customer verification, and they're going to provide this with relative anonymity through zero knowledge proofs. So interesting things coming out of Coinbase. Now, Robinhood, not to be left behind, is going to do something very similar. They're going to let users hold their own crypto. And again, they're going to say, let users hold their own crypto. I would bet you Robinhood does not want the burden of holding everybody's crypto. But I think it also shows you that in this space, the people want to hold their own crypto. And they're going to do something very similar. They're going to hand over their keys to some of its customers' crypto. And it says in this article that they're doing it honestly to keep up with Coinbase. So there you go. The appetite for owning your own crypto is strong in this space. But hey, we're not done talking about Coinbase. So Coinbase Cloud and Figment are going to team up, and they're going to back a new liquid staking protocol. For those who don't know, liquid staking is growing quite rapidly. It had grown from less than 1% of market share in 2021 to more than 30% currently. And the advantages of liquid staking is you can essentially remove your assets at any time from a staking pool. So, traditionally when you have to stake things, you lock them up. You're a liquid, you're trading your liquidity for yield. With liquid staking, you are not trading a liquidity for yield. Now, typically liquid staking offers less yield. There is a trade-off there, but Coinbase is getting involved in that as well. Coinbase is very interesting to me. It always has been. I think it's a very interesting stock to invest in. I personally am not invested in it, but I'm considering it. So anyway, take a look at all these articles. I will link everything in the description of the video. Now let's get to some stables. Everyone's familiar with Luna and Terra. There's another algorithmic stable that just lost its peg, and significantly. I'm talking about DEI. I don't even know how to pronounce that. I've always called it DEI. Now, DEI has a mechanism by which there's collateral for minting DEI. You have to collateralize $1 worth of crypto or asset to mint $1 to mint one DEI. Now, it's lost its peg. It's down to 64 cents at the time of writing of this article. And what I think this shows you is not all stablecoins are created equal. I think that there are two stablecoins that will survive and really are worth investing in, and that would be fiat-backed. So we're talking UST and we're talking about USDC. And I do think something like DAI can survive, which is over-collateralized stablecoins. And the more over-collateralized, the better, in my opinion, because crypto is so volatile that if you put up $1 of collateral, in a month, that $1 might be 40 cents. I mean, think about if you put $1 in November when Bitcoin was 69,000, right now it's around 30,000. I mean, it's quite a drop, right? So yet another stablecoin is depegging after Terra. So in my opinion, I think these algorithmic stablecoins I'm going to be frank, are garbage. I'm sure there are exceptions. I'm sure you can point to one example and say, but look at this one. Yeah, fine. We'll keep playing those and see how it goes. I'll stick to my USDC. I'll stick to my, well, Tether is another thing. But, think about Tether. They just had a $7 billion run on their supply, and they're still able to back up their reserves. The reserves are there, at least enough of them. Billions of dollars of reserves are there. Is it 1-to-1? Probably not. Is it even 50% of all Terra supply backed up? We don't know. We need an audit, but it's certainly more robust and more resilient than these algo stablecoins. So the next story is just about that. USDC, which I think has come out of this Terra thing as the pure winner, to be perfectly honest. It hasn't flippened USDT, which is Tether, but traders are increasingly being driven to USD because they believe it is a safer stablecoin bet than all the other stablecoins. They believe that it's the most securely collateralized. There's the most reserves there. And this is what happens in economic pullbacks and recessions. People become aware of risk when things are good and everybody's making money and there's 20% yield on Terra. Everybody thinks, okay, this is great. Everybody's doing it. I'm going to do it too. And then people get smacked in the face and they immediately turn to fear and they go to these reliable products like USDC. Now, I can't speak to how reliable it is. Again, there's no audits on this that I'm familiar with, but the rumor mill, or the way that crypto thinks and talks about USDC, it is probably one of the safest, probably one of the most stable coins, and it has a good old-fashioned fiat-backed system, which I am a proponent of. So I'll leave a link to that as well. Oh, this is cool. I don't do a whole lot of speculation on this. I just not my game. But this is an analysis of Ethereum whales and what they're buying, and there's a little chart here. So, hey, this goes with the last article. So USDC was at the top. Whales were purchasing it the most. And then right under that was Ethereum. No wonder Ethereum whales are buying Ethereum. And then Tether. So, hey, the market is moving to, I would call, blue chip crypto, Ethereum, and stables. And at the top is the most trusted stable at the time, USDC. UST, Terra, is actually being bought. I believe that's for ARB opportunities. And you also get Maker, which is DAI, which I talked about, the over-collateralized stablecoin, which I'm all right with, Curve, and Chainlink, which is an oracle that I think will be around forever. So kind of interesting to see that. Take a look at this article if you're interested in that. And the last thing I will finish with is Do Kwon pushes on-chain proposal. We have to have a Terra story, right? So he wants to fork Terra. He wants to cut out the UST, and 92% of the community apparently is not in favor. And it seems to be a trust issue. So basically, Do Kwon is saying, let's keep Terra classic. Basically, we'll have one fork where things just continue as they are in the current timeline, and we'll have another one where we roll back and we end up before the depegging and the crash and all that. And the community is basically saying, hey, we're not going to let you just move on. They probably want restitution, and they want him to focus more on the current mess than to just go on and make a new mess. In my humble opinion, these sorts of forks can make sense if, Ethereum forked, as an example. There's Ethereum Classic and there's what we know as Ethereum Canonical, right? It can make sense. In this world, I think it makes absolutely no sense. I think Do Kwon, particularly how he's handled himself in the spectacular fashion in which this chain fell, and it really was predictable if you were paying attention. The algorithmic stablecoin UST was very poorly designed. In my humble opinion, it was a Ponzi. It borders on scam. And just to say, oh, I'm going to do a redo. It's like, okay, you can follow him if you want, but people do not want to follow him. Now, the interesting thing about the story beyond this is that governance can actually override the community's vote, which shows you some of the inequity in Web3. So, the myth of this being Web3 being a democratized, meritocratic, equal system is kind of being shown to be not true. I mean, in many different instances, but in this one as well, because there's enough governance votes to put this through, even if 92% of the community is not in favor, which shows that the problem of human organization isn't limited by new technology, it's limited by people, which is another way of saying, sure, we have ledger technology right now, but we're still the same apes. We've got a new pointy stick, but we're still the same apes wielding that pointy stick. Anyway, that's my pessimistic view to end this news today in crypto. Anyway, thank you for joining. If you find this useful, I would ask that you leave a like and a subscribe, and I will catch you all in the next one. Remember to ape responsibly, would you? Peace, dudes and dudettes.